Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your hosts Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. Welcome to Monday morning snowy edition of Benzinga's PreMarket Prep, brought to you by Benzinga Pro. I'm your co-host Joel Elconin, along with Dennis Dick. Spencer Israel is making his way back from Chicago. Some flight delays, so he will not be in for today's show. But we got a lot to cover here, and it's going to be all about oil. Oil surges as the Saudis eye deeper cuts, while non-OPEC countries want to join the deal. We have a failed drug trial for OPHT. We got an upgrade for REGN. We got a couple great guests on today. My longtime friend and colleague, Frank Longman, Managing Director and Technical Analyst at Breen Capital. He'll be followed by Gil Morales. He's a proprietary trader and the CEO of Gil Morales and Company, a registered investment advisory firm. And you're going to talk to a guy that worked with the legendary William O'Neill. 802, Dennis, how am I doing?
Better than me because I was on mute. How's it going? How's the weekend?
The weekend was pretty good. Kind of a snowed-in day yesterday. Watched a lot of football. Did a lot of
big
things.
Lions
Yeah,
victory.
big
That's
Lions
a big
victory.
one. Yeah, over the Bears.
Oh, and I had them in my suicide pool. I was just about ready to jump out the window, but they came through.
They pulled
Yeah,
it out again.
Yeah, a lot of exciting games. Little trouble getting out of the driveway this morning, but I just plowed through, and the roads aren't too bad here. It is a school day. I can't believe they called off school today. The roads look okay, but they got to get those school days in before the end of the year.
So let's jump into this market. If you look at the S&Ps, you think, oh, nothing day. S&Ps are just hanging out here flat on the day. But then you take a look at oil, and you're like, whoa, what's going on with oil? USO, if you want to look at that, up 4.28%. If you want to look at the crude, Joel will give you the numbers on the CL.
Yeah, crude is trading up 240, opened unchanged basically, and then just went straight up $2. As I mentioned at the top of the show, OPEC, it looks like they're getting their act together. The Saudis eye deeper cuts, while non-OPEC countries are going to join in, primarily Russia. So everyone's getting on board with this, and they just took the crude straight up basically to 54.51. I don't even think I had a level up that high. Backing off a little bit. They like the S&Ps on that too. They took that straight up, but the S&P is now 10 points off its high. So
Wow.
yeah, a little bit of retreat in the S&Ps, a little reversal. But boy, oh boy, we got a lot of oil stocks to cover.
Yeah, and we're jumping to the oil stocks in just a second, but I just want to talk about rotation here once again. And always when I come in, the first thing I look at, okay, what's the obvious driver here today? Well, this one's an easy one. It's oil. So your oil stocks are going to be hot. So that's probably bad news for your airlines. So if you're looking at stocks like American Airlines, LUV, with oil trading up as much as it is, I would expect there to be some pressure on the airline stocks. Then you start thinking, okay, well, what else is looking on my screen? Well, financials look kind of strong. We know oil and financials have been somewhat correlated here, so financials are catching a little bit of a bid. Defensive stocks going to be weak here again. The bonds are getting hit here once again. TLT is trading down. XLU is trading down here in the pre-market over 30 cents, which is almost 0.75%. So you're seeing weakness there. And then a little bit more surprising weakness, actually, the NASDAQ. If you look at the QQQ, it's trading down 50 cents here in the pre-market. And you are seeing some NASDAQ stocks like Microsoft trade down about 25 cents, Intel. So if you're looking for what might be potentially weak here today, Apple's down 50 cents. Think about the tech stocks being a little bit weaker, and obviously anything to do with oil is going to be flying here. And maybe we should just jump right into some of these individual oil stocks because a lot of these stocks are breaking out to new highs on the move.
All right, well, let's start with the biggest and the baddest of all of them. That would be ExxonMobil, your second biggest component in the S&P 500. currently trading up $1.30 at 90.30. 42,000 shares have changed hands so far. Pre-market high 90.74. We've backed off a little bit. Now, last time that ExxonMobil was in the 90 handle. Dennis, let's see if you can take a guess on this one. We kissed up against it earlier in the year. What we really have not.
Summer.
Yeah, over the summer here. Dennis, is there going to be enough stock in the book here to keep this down for, where it's okay to buy the open? Because only 42,000 shares have traded. And if you think about how much you would need to
I
move it
bet
up.
there's going to be some stock at 90. I
Okay.
don't see anything in the book there right now at 90, but it's early here yet, so I think there's probably going to be some stock in the New York book at 90. That might hold the opening price down to $90. We'll have to see obviously what oil does, but after the next hour and a half here. But I'm a little bit skeptical here on this rally. So yeah, it's awesome news, but this was already rumored. We already had and you wonder here now you get a huge spike in all of these stocks if some profit takers don't actually start to come in here, but. ExxonMobil, I'd look at the bogey at 90. I know it's trading at 90.30 here, even bid at 90.34 in the pre-market. I think it might struggle to open over 90, though, so that's my call here for this morning. We'll see if that does open over 90. Jumping to the other big gun, Chevron, CVX, that's trading up substantially in the pre-market as well. It's up over $2, but these are the lower beta ones. So when you're looking at an Exxon, when you're looking at a Chevron, these will not move as much as some of your other ones. When the other ones I'm talking about, are some of the smaller ones, even like a Halliburton or a Schlumberger, those are going to move more from a percentage basis. But some of these other smaller companies, if you want to jump into like a Whiting Petroleum, WLL, that's trading up 10% in the pre-market. Chesapeake, which is a lot of natty gas in there, but still oil as well, it's trading up almost 7% here in the pre-market. So if I look at my scanners here this morning, it is littered with some of these smaller oil companies that are in a lot of trouble. And when you see oil pop like this, it's going to help. So you see even some of these other ones like ORIG, which I believe was flirting with bankruptcy, just talking about bankruptcy, even as much as just a few weeks ago. Stock got down to like 67 cents. It's up 21% here this morning, trading back at $2.65. So some of these smaller little oil companies that are really struggling to survive, this is huge for them. So that's why you're seeing a big pop in some of the smaller ones. And obviously ExxonMobil, Chevron was going to survive no matter what. They're getting a pop, a nice pop, 1.5%, but nothing like the 10% pops that we're seeing even in a DY, or actually not DY, but just looking through Seadrill, SDRL is up 18%. TDW is another one. Is Tidewater? Yeah, I believe it is.
Yep.
It's trading up 13% here in the pre-market. So there's got to be about 30 companies that are trading up 10 to 15% here this morning. All smaller oil companies.
And it's important. I mean, I know we talk about, different things. We always talking about the openings. We talk about the pre-market highs. I mean, that's just, even today in these kind of circumstances, like for ExxonMobil here, see what happens at that pre-market high. See if it could take out 90.74, go 91 bid. I mean, there's going to take a lot of stock to get through there. Opening print, we always talk about that. Maybe throw something in there in the lower 89 handle. Maybe get get some stock holding it down. Right now, though, in ExxonMobil, the lowest it's traded since that 4 a.m. open was 90.10. So I'd keep an eye on that. 90.11 actually was the first print. Or the lows coming off that 4 a.m. open. What is there? A few other oil ones here. You mentioned O-Rig. That's a favorite of Matt Kolb's.
That's a small one.
Yep, that's a small one. WLL. What about Rig? Is Rig moving on this as well?
Yeah, Rig's up. Pre-market here up 7%, so Rig's getting a huge pop as well. And again, these are the companies that were really struggling to survive. So as oil is now back in the mid-50s, now you start to see these companies that, were flirting with like, oh, we're in trouble here, start to come around. It gets back to 60s, 70s, 80s. Some of these companies are going to become profitable again. So Transocean here up 7% in the pre-market. It's been a huge 3-4 day move here for Rig here. It's been taken off actually. I'm dying here, Joel.
Look at
it's
that.
been taken off over the course of the last 7 days. Up 8 days in a row here for Rig now. You just wonder, we always talk about capitulation. That's what we talk where all the buyers say, I need to get in. All the shorts say, I need to get out. And you have this big gap up open and everybody, and that's the top. And you wonder, and I'm not trying to call tops here because we've tried to do that to financials multiple times, but you just wonder if this event here could be a short-term top.
And also, we're going to have a guest on later in the week that really follows the oil market very closely from a macro. She's a Middle Eastern studies, and I talked to her. I've been skeptical about OPEC actually, following the recommendations of what they're doing. Right now, they're saying it, but really, it comes out whether or not they actually cut production. You can say you're going to do it all you want, but you have to wait for the oil figures, and we can talk about that later in the week. But it's providing a nice boost to the market here. Oil stocks, a big part of the S&P 500. They're getting a boost. Good for the financials, right? Because a lot of these financials have loans tied to.
Yeah.
Yep, that's another reason, another boost for the financials.
I mean, we just keep finding reasons to buy the financials. There was an article that I read over at Barrett's just online. Not sure if that was in the paper version because I didn't buy the paper version this weekend. But they were talking about the financials. And they were saying, "Man, it's been such a run. They're priced for almost perfection here now." And they thought that there could be a significant pullback coming. Was that in the paper version as well? Did you see that, Joel?
When I flipped through the paper version this weekend, I did not see that. So,
That was maybe just an opinion one article there on Barrett's Online, but I was reading and I was like, I keep saying it too. I mean, eventually there's going to be a significant pullback here in the financials. I just don't know where that is. And it seems like if you're trying to call it, which I've tried to do multiple times, it's just very difficult to do because there's just so many people who, obviously missed the rally here, who want to be in the financials. They're coming towards the end of the year. The money managers who are underweight the sector are scrambling every time there's a pullback. I mean, even on Friday, we had a little bit of a pullback there just off the open in some of the financials. And by the end of the day, they're green again. It's like Groundhog Day. We keep saying it every day in here. It's like if you come and you buy the close on Bank America, and almost every single day I come in the next morning, it's up another percent. So I don't know when that trend breaks, but man, it has been easy. If you've just been buying the close and selling the open, and making money every single day almost.
Yeah, a couple tops in Bank America. Actually, you have a few highs from the last two sessions we'll keep an eye on. 23.17, 23.24, traded up to 23.40 in the pre-market. So it looks like Bank America is gonna continue. Let's before we bring in our first guest of the day, let's do our disaster stock of the day. OPHT here, taking a big haircut. The news I got is says primary endpoint not met in phase 3 trial of Fovista here, Dennis. Disaster here, just hanging out at $7.
Down 81%, Joel. So, you see one of these every once in a while. We see one of these one-trick ponies, it seems like, these biotechs here. This had the fall from grace back in the summer. It was $60, got down to 30. Now it's down. Now this is the real fall from grace down to 7. Again, you come in here and you think, okay, well, eventually these things will bounce back. I've tried to buy a couple of these before, and they don't seem to come back. So, the odd one might, but, I mean, Sarepta did, but I don't know. OPHT, this is a really ugly chart here now. $7 here, keeps drifting lower at the pre-market as well. What's the pre-market low?
Pre-market low is right here where we're trading. No bounce yet. 7.18, that's your pre-market low. 7.20 is your last trade. So not showing any kind of bounce here yet, but obviously trading down over 1 million shares have traded. Not getting a bounce, Dennis. I know you won't take it, but I think it closes above 7.
I'm not taking it, but I think there'll be some people maybe who are short the thing, bringing it in. But I don't know. These things are crapshoots now. It could go down to 6, it could go down to 5, it could rally up to 9 or 10. This is just out of my wheelhouse. This is the opposite of boring. I like making my money off boring, and this is the exact opposite of that.
All right, we are going to take our first break of the day, and we're going to bring in Frank Longman, Managing Director and Technical Analyst at Breen Capital. We're going to review some of his calls from his June appearance and see what he's looking for in 2017. We'll be right back with Frank.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need thinkorswim. To experience everything thinkorswim has to offer, open a TD Ameritrade account today. thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Dennis Dick. And we have Frank Longman on the line, Managing Director and Technical Analyst at Breen Capital. Frank, how you doing today?
Hey, I'm great. Good morning. Thanks for having me.
Yep, and Frank, a long-time trading buddy, back at Oldie here, a man that really knows his technical analysis. Frank, we had you on in June here, and you were not shy about some of the calls that you made, and some of them turned out to be pretty good. So let's review. Let's start here with the semis. You were looking for that as leadership. That's up 21.2%. I have the SOX index up here. Is it time to take some profits in this, or don't get in the way of a nice trend?
Yeah, no, I think I think it really just depends on your time frame. It's semis are extended here. I would take some profits. They hit my target right around here. I think 70 on SMH was what we were looking for. Just using technicals and stacking that base that they looked like they were going to break out of back in June. So the breakout was 60. The trade or the setup was to 70, but they're still trending and outperforming. And what we usually say in that case, our audience tends to be a little bit slower, than the trading community. So we usually say, hey, don't be afraid to trim and trail, right? So trim your longs, trail a bid, no interest in shorting this trend, right? They still look like leadership, but I think you can be opportunistic with the dips from here, especially, today it's really easy to say with I think the S&P is on 7 straight up days. So,
Yep.
I think you could see a little near-term vol.
All right. Now, without knowing any of the outcome of the election or what the economy was doing, you loved heavy construction, especially over the home builders. I don't know if you put a pair trade on that one with the XHB or not, but how are we looking in these two sectors?
Yeah, I think we're sticking with heavy construction. Technically, we think you caught cycle lows, in earlier in the year, and a lot of names, had gotten cut in half to get down to there, and they were just starting to turn up when we looked at them in June. I think so. Technically, you've got big bases, definitely cycle bottoms, possibly even secular bottoms, and intellectually, I think it's long been kind of a given, or at least for me, that fiscal policy is the natural progression to this, this policy-driven bull market, and that's exactly what people are getting excited about here.
And it's interesting that you came up with these theories. This is way back in June before Trump steam got really running, and just turns out what you saw on the charts and what you were looking at fundamentally, is proved out in the markets. Back in June, you thought rates were low and looked like they'd stay low. Boy, this needs to be taken a look at again. They're historically low, Frank, but
yeah, I think in that note I sent you this morning, I put my 2017 preview out. I think now it's looking like the bond market saying, hey, wait, you're gonna cut taxes, you're gonna jam spending, fiscal policy help across the board, with lower tax revenues, and the bond market saying, hey, hold on a minute here, I don't know what you think you're going to get away with, but we're questioning it, right? Hence the bond sell-off. So for me, I think you're going to see 3 next year. I still think that's long-term low. Although let's say that the June call right? We have to call that wrong, right? I mean, you went from 170 to 250. So I think that, the rate pop starts to look impulsive, and you're seeing a lot of things, steel stocks, you saw energy coming out of the bottom. When these things get ahead of steam, we don't want to stand in front of them, So my pet thesis is that you see low twos on the 10-year before you see 270. So you're at 250-ish here. And I think that's probably an opportunity to make your bets. I mean, we've been kind of in the financials trade, and that's partially driven, by the curve. I don't think it's completely driven by the curve, but I think you can kind of see. I think you see 3, but let's call it a 2 to 3 range for now on the 10-year, and you're at 2.5 right now.
And they were looking, everyone was so convinced we were going to get 4 rate hikes in 2016. Kind of a similar scenario, 2015 they did the rate, but man, 2, 3, 4 more hikes. I just, the economy is showing a little bit more strength here, but boy, oh boy, can it withstand that many interest rate hikes. So just going into, next part here, I know your technical analysis, you like to look at some wave action here. We're getting some pretty classic fifth wave action here. That doesn't necessarily mean that we're putting a top in, but tell them what you're seeing us from a wave theory standpoint.
Yeah, I think that's a great question, and it's obvious. It's definitely a pet of mine. So, before I get into that, let me just say real clearly that we never know what the market's going to throw at us or what's going to happen, right? So what we're doing is we're sketching out a technical framework, right, and then we're looking for the market to give us information that confirms or denies it, right? So we're really just defining tendency, and then looking for the market to prove or disprove that construct, right? So, if we're in fifth wave, right? So for starters, you say fifth wave, people think you're calling the end of it. I've got a 2486 S&P target, and that's just, I'm using a fib extension, so that's hence the specificity. But, so I think that the S&P could easily have 10% up in 2017. And, for perspective's sake, if this is the fifth wave, we just started it coming out of Q1's low. So we're at, call it 25% off the Q1 bottom right now. And the fifth wave, tends to kind of match the first wave, at least points wise, which would get you, I think it's 25-12 or something like that. So, impressionistically, if we're sketching out what we think, like you want to put me on the hook for one, I think up 10, down 25. Right. So let's focus on the up 10 for here. And, it's not like I'm going to be blindly fading the market at S&P 2486. We'll just be looking for reasons to expect a top.
All right. Could you just go into a little more detail on the wave analysis, just for some of our listeners that aren't familiar with it?
Yeah, I would say, the basic thesis is that a bull market traces out in 5 waves. Waves 1, 3, and 5 are impulsive up waves, and waves 2 and 4 are corrective down waves. So I think the 2 was the 2011 correction, the 4 was the correction at the beginning of this year, and now you're in the 5 or the fifth wave move up, which will also subdivide into its own 5, right? I don't know that this is necessarily radio content, but what you historically see is stocks get too cheap at a secular low like 2009, right? And then they it doesn't take much to turn them up. They turn up, they generally double off of that bottom. And, then they get ahead of themselves and you pull back, right? And then when the third wave starts, usually that's a growth phase, right? In this case, the third wave ran on policy, right? So it was like this new paradigm. There's a Fed put, right? We need to own stocks. Rates are low. Bonds are relatively unattractive versus earnings yields, what have you, right? And then the fifth wave is historically this kind of new paradigm, like you think the internet's going to change everything, or anything like along those lines, right? The fifth wave tends to be new paradigm. What's happening in this cycle is that the third wave ended up being new paradigm policy driven, and the fifth wave is growth driven, and it's something that we haven't really seen before. So I think that if growth does materialize, this fifth could actually end up extending much longer.
And let's talk about just like the impact on active managers here, from a game theory perspective. I mean, you're out there with some of the boys. Tough year. I mean, some great buying opportunities, with the Brexit, also with the election. Those took place overnight. I mean, you got some guys that are just probably scrambling, scratching their head, figuring out how to match the market's performance for this year. Talk about what this all means for active managers.
Yeah. So I think fifth waves tend to be narrower, right? Which means worse breadth, more specific leadership, right? You tend to see higher dispersion of returns at the stock sector or group level, what have you, right? So like right now, if you look at financials versus utilities, they're completely blown out, right? They're still both still have a positive correlation to the S&P 500. So correlation's still up, but dispersion or the spread between those returns is widening, right? So, I think that's something really important because what we're talking about, if we're talking to, longer term active managers, right? They're competing against passive benchmarks. Say I'm benched to the S&P 500. Now, in wave 5, there's an opportunity to outperform the S&P 500. If you were long industrials, materials, energy, and financials, and you were short low vol and tech for the last 6 weeks, you just blew out performance by a meaningful degree, right? And that's pretty classic of what we're seeing here. So if I'm competing with the S&P 500 as an active manager, right, with a longer time frame, my choices here are to say this is wave 5. It tends to go further than people think, but it also also sometimes, quite often, truncates or cuts short. Right, we have to kind of walk that razor's edge between how much are we getting, in this late cycle bull. So do I want to be hyper active or very active away from the benchmark and try to play these spreads, bet that the financials trade is going to continue or industrials are going to continue, what have you, or do I want to just kind of hug up to benchmark? We're saying that the thing to do here is to be very active and try to gain back some of that performance versus bench in wave 5 up, where we all know that active it better outperform passive on a next dip, right? If we get a 25% market correction, right, that's 25% on the headline S&P. So if you only lose 19, you gain back 600 bips, which might mitigate 24 to 30 months of underperformance for a lot of people.
All right, let's look forward. Let's look forward here, and I'm looking at your note here. The setup, the signal, and the noise. The 2017 domestic equity preview. I mean, I think that hits it right on the head. The setup, the signal, the noise that you're getting in the market here. Tell us what you're looking at here for 2017.
Yeah, so I think the baseline for me is. I think 2486 is a nice topside target. I think we're playing that until we see evidence otherwise. I would have to see the S&P fell 2120 to start worrying about it. I think right here I'm kind of in the hey, I'm pretty bullish, but I'm not buying a whole lot right here. We were pretty fortunate to have industrials and financials right going into the election, despite not having any opinion on the election. And obviously the E&C trade's been good, but it's pretty small relative to benchmark, so that doesn't move the needle as much as running financials in the high 20s versus a 21 bench does. So I'm mostly opportunistic dip buying, thinking you hit the 10% point some point in 2017. Dancing, but with an eye on the door, just in case something goes wrong. So we start questioning if we see it slip under 2120. I worry a lot if we break 2050, that's 200 points away now. So the skew from right here, I'm basically framing it out as up 10 versus down 6. If I catch 200 bips down, that's up 12 versus down 4. So I'm a dip buyer. I wish I could say I was doing something super differentiated.
No, that's what you have to do. Dennis, any questions here for Frank before we go to the individual sectors?
Frank, just give us some stock picks here going forward for 2017. So, I've been listening in here in the background. Great content. Loved hearing about that wave theory too, and about how institutional money managers, have to obviously look and analyze what's happened here over the course of the last few weeks. And I know that it's been a difficult market to trade, and even as a trader, just because these moves here seem so out of the ordinary when you get one directional move so persistent here. What do you see happening here in 2017? Is this going to be a continued trend that money's going to keep flying into the financials, flying into some of these stocks? They call them Trump stocks, or do you see this eventually reversing here?
I think that financials have to lead on the fifth, Dennis, and that's something it's a big part of the benchmark. They'd been lagging for a while. It's the reason why we were long them before the election. I think that you're 20+% of the S&P with financials, and I had a note. I think it was 2 days after the election, which was it basically said, and it was half right. It was a half right note, right? So I basically said, hey, eat the whale. Don't eat the barnacle, right? And the case was, let's go buy financials. They matter. Even if you overweight financials by, 10%, right? You get the same impact as you do doubling your exposure, from versus, doubling your exposure in materials. So what I was saying was, hey, let's not go crazy, buying these steel stocks, which was a terrible call, right? Let's go out and let's really take financials up to heavy. And so on a risk adjusted basis, that call's great. And that's kind of what my clients think about, right? And it's more palatable because a lot of those steel names that have gone up, 70% since the election, those are pure beta plays, a lot of them, right? There's a lot of leverage in the balance sheet, and you're basically making a beta trade, when you do that. Whereas I think with a lot of these financials, we can go buy trust banks or a big basket of regionals, and I think the floors tend to be a lot higher in those.
Frank Longman, Managing Director and Technical Analyst at Breen Capital, recapping his 2016 calls, looking into 2017, not getting in the way of this bull yet. Frank, great content. I can't believe I haven't had you on since June. So let's keep in touch, and we'll get you back on early in 2017.
Hey, thank you for having me. And let me just drop a quick plug. I see you have Gil Morales coming on today.
Yep.
So I don't know Gil personally, but I've followed him from afar for a good 15, 16 years since he was at O'Neill. And for a trading audience, his book, I think it was called In the Cockpit with the O'Neill Disciples. That's the best trading book I've read in the last 3 years. So I'm looking forward to hearing Gil.
All right. Thanks. Nice plug there. Two great guests today. All right, Frank, we'll let you go. Dennis, 8:33 here. Any imbalances here to take a look at?
Some significant ones here. Financials coming out with sell imbalances here this morning. They've been trading up in the pre-market. They've been trading up on the strength of oil. We know, like we were saying earlier, that the oil stocks and the financials seem to follow them a little bit here. Citigroup 201,000 to sell. Bank of America 265,000 to sell. Wells Fargo 109,000 to sell. So obviously, some institution looks like they're taking some profits here from the moves here over the course of the last couple of weeks. We've seen that though. It's been a little bit of a trend, and then we see a little bit of a weak open sometimes, and it seems like they just come right back and buying them anyways. But that's a couple significant ones to look at. Alibaba, which has been very, very weak here in the pre-market, just came out with a buy imbalance of 174,000. That's significant here as well. Stock is getting bid a little bit more since then, but again, it's early here. One institution can offset that, so I don't know if I'm putting a lot of weight in that. Stock is still trading down 83 cents here in the pre-market. Oil stocks all littered with buy imbalances. That's obvious because of oil. Really nothing else too much jumping out at me here. They're small. GM 55,000 to sell. General Motors, just an incredible move here over the course of the last 3 or 4 trading sessions. A stock that was left for dead just about a month ago was at $31, is now getting close to $38.
All right, we are going to take our second and final break of the day. We're going to bring in Gil Morales, proprietary trader and CEO of Gil Morales and Company. Worked a lot with Bill O'Neill, so we're going to get some advice or some tips from Gil Morales. We'll be right back.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elconin, along with Dennis Dick, and we have Gil Morales on the line, proprietary trader and CEO of the Gil Morales and Company, also the author of the Gilmore Report. Mr. Morales, how you doing today?
I'm doing well, Joel. How are you doing?
We're doing good here. Snowy day here in the Motor City, but a school day, but work still goes on. So let's just we know that you worked with William O'Neill. You've written several books also on the markets, but how did you get started in this? Did you always want to be involved with the markets and being in the investment world?
Well, the reality is that when I got out of college, after graduating from Stanford, I wanted to be a professional cartoonist, and I actually published a couple of cartoon collections, which, by the way, you can still buy on Amazon, believe it or not. And I did that for about 10 years before I realized you can't really make money unless you're Charles Schulz or Gary Trudeau. Otherwise, it's a rough way to make a living. And so in my early 30s, I was just looking for a job, and I happened to come into a Dean Witter office in Pasadena, and I was working on, I think at the time I was trying to start an illustration business, and some guy wanted me to do some illustrations for a brochure he was working on, and I met the manager, a guy who used to be the coach of Colorado, but football coach. But anyways, he told me he thought I would do well in the business, and so I wanted to get a job at the time, so I was running around looking for places to start as a broker, and I figured if you're going to be a broker, you might as well be a broker where the money is. So I went to the Beverly Hills office of Merrill Lynch and just walked in one day and told them I wanted a job, and the sales manager laughed at me and said, yeah, well, what do you think brokers do? And I guess he was looking for me to give him some rigmarole about how they help people plan their financial future, blah, blah, blah. I just said one word to him. I said, sell. And they hired me on the spot. So I started as a broker there, and while I was there, I sat next to a little old guy named Harry Wayne, who was about in his mid-'80s, I guess, late 80s, and he just happened to be Bill O'Neill's first boss back at Hayden Stone. He actually claimed to have hired Bill, and he always had the maroon database books on his desk. So immediately he and I hit it off because I had just finished reading O'Neill's book, and we became pretty decent friends. And when he retired, I moved over to Payne Webber. He opened an account with me and was showing Bill O'Neill his statements because we were doing pretty well at the time. I think I was in '95 during the tech boom, if you all recall that. And Bill O'Neill came along and recruited me in 1997 to come and run money for him, and also to head up his institutional services group, which at the time was responsible for advising, I'm going to say, 600 to 700 of the world's top institutions, and that would include everybody from Fidelity to Strong Funds to Foster Friess, George Soros, Mario Gabelli, Louis Navier, you name it, the whole gamut of top money managers. And so that was a great experience, and I did that for 8 years, made a ton of money, and decided to retire and just kind of mess around back in 2005. And so since then, I've been authoring books, and I have a couple of websites, GilmoreReport.com and SelfishInvesting.com, and written my books and trade my own money now. So I'm basically a proprietary trader, and that's pretty much how I earned my living, so to speak, even though I did technically, I'm going to say from a financial standpoint, retired in 2005 when I left O'Neill.
And so, what
And
did
that's how I
you?
got
Yeah,
here.
what did you learn working with that Bill O'Neill? I mean, obviously he
Well,
has
Bill
his.
O'Neill is a great stock market mind, and the guy has an instinct and a nose for the market. And I guess I understand he had some health issues now with, I heard dementia or something like that, which I think is terribly sad and unfortunate. But when I worked for the guy, he was a brilliant stock market mind, and he taught me a lot of key things about the market. The main one being what I call the big stock principle, and that was that you need to understand the big stocks that the institutions are trafficking in at any given time. And those are the ones you want to be in. And if you think back, Jesse Livermore used to talk about the so-called issues of the day, so, the big stocks of the day that everybody's trafficking in and where all the money's moving around. And that was something that I took to heart because when I first got there, I liked to buy $12 stocks, $15 stocks. He used to give me a bad time. He's like, oh, you got to think for teenagers, don't you? So he used to call me a stock pedophile, which I don't know if that was a compliment or not. But he taught me to look for big stocks. He'd say, you want a stock trade $60, $70, $80, $100, $200, stuff like that. That's what the institutions are buying. And I slowly came around to understanding that, and then I started to make big money there. And so that was a big lesson for me. The other part of the education, there was understanding that there's more than one way to skin a cat. When we were advising over 600 of the top institutions in the world, not all of these guys, in fact, none of them were really Can Slim type investors. I mean, after all, they're the guys creating the breakouts. You see a stock breaking out of a base, well, those are the guys doing it. So you're going to tell them to buy a breakout. They're the ones creating the breakout. Not only that, they're the ones creating the bottoms of the bases from which the stocks break out from eventually anyway. So while I was there, I got a good understanding of what they look for on the bottoms. And my colleague at the time, Dr. Chris Katcher, who I worked with on selfish investing, he was my analyst. And he began working on something that eventually became the pocket pivot idea, which is the fact that if institutions are buying at the bottoms of the bases or even, say, the midpoint of a consolidation rather than on the breakout, and they could be buying there as well, but you want to get in, at the most optimal price level. And so right after he left O'Neill in 2001, he started studying this concept of a pocket pivot, which is looking for an institutional, say, price and volume signature that would hint that there is institutional accumulation at the lows or the midpoint of a base, and looking for a particular signature for this. So he came up with the pocket pivot, and we've since expanded on that to roundabout pocket pivots and bottom fishing pocket pivots, continuation pocket pivots, and so on, because institutions don't just buy breakouts and then sit there, averaging up every 2%. They're buying on the basis of their fundamental analysis, and as long as a stock can be considered to be fairly valued from their perspective, they're going to keep buying it. And so you want to be looking for those key signatures, price and volume signatures in the pattern that will lead you to proper buy points, besides just a breakout. In fact, these days I don't even buy breakouts because I think they're mostly sucker moves, and you usually get a better chance to buy on a pullback after a breakout or buying earlier before the breakout using pocket pivots within the base. So all of those things and, getting to work with Chris Katcher, those are all the benefits that I took away from O'Neill. And big learning experience there. I'm very grateful for it. It's obviously very lucrative for me as well, and I was there at the right time. You started in the business when, Joel? In '85?
Yep.
Was it?
Yep. Down
Yeah.
at the.
So you got there just before the '87 crash. I actually knew a few brokers at Merrill who started their first day in the business as broker trainees was on the crash day of 1987. But, the 90s were like a huge tsunami, even monkeys pushing buttons would have made big money, and even turkeys were flying because it was a hurricane. Every stock on the planet was moving higher. So that was a great time to start in the business when I did in 1991, and I'm going to say I exploited it to its fullest, and I'm grateful for that opportunity.
Joe, I can relate to this actually because I was trading retail there. I started trading retail in 1996, and I went prop in 1999. And from 96 to 99, I really didn't have any losing trades. And you go in there and you think, oh, you know it all as a young buck.
Yeah.
And you think, oh, well, the market's been going straight up, though. You just don't realize. You think you buy anything, it pulls back, we just wait for it, it comes back. I mean, we were in the tech boom there.
It turns around and goes back up, right?
I know, you couldn't do anything wrong. So I look at myself, and then in 1999 when I went prop with Bright Trading, I was like, whoa, you start to realize there's a lot more going on here. And I was more just, lucky to be in such a bull market as opposed to really being a skillful trader. Now I look at the market here and you wonder, we've been in a 7-year bull run here. I know we've had a couple years of consolidation here, but it's starting to take off here now. How do you differentiate between, knowing whether you have a good skill set or a good trading strategy going, as opposed to just being, in a good market?
Well, Bill O'Neill always told me that the mark of a great trader is the ability to come back from periods where you're going to get hit. And he said every trader is going to get hit. I saw Bill O'Neill get hit when I first got to his firm. He had a huge position in a semiconductor. I can't remember the name of the stock, but it had a 35% drop in one day, and everybody was running around the firm saying it was going out of business. The company was going to go out of business because O'Neill took this huge loss, but he came back from that. But a good example would be in 1990. I think it was 1998 when I started running money for O'Neill, and I was up 45% to start the first 3 months of the year. And then the CFO, this guy from Memphis, Tennessee, named Don Dre, comes into my office, and he's got a list of all the internal portfolio managers, which included guys like David Ryan and Lee Freestone and others. And he comes in and says, he's looking down the list, and he says, yeah, Morales, you're up 45% so far this year. And I'm, of course, blowing on my fists and rubbing against my chest, I'm doing such a great job. He says, well, around here, you're just average. Anywhere on the street, you'd be a superstar, but here, you're just average. And that one hit me right in the face. And from there, I went down 70% to minus 32%. And that was would have been in September of 1998. But by the end of the year, I was able to recover, and I finished up a total of 68%, which is a 100% move off of my lows. And at the end of the year, Bill O'Neill comes in to give me my bonus check. And he's laughing. He says, for a second there, I didn't think you were going to make it. But he told me the fact that you're able to come back tells me you have what it takes to be a great trader. Because to be faced with adversity like that and to be able to come back is the mark of a great trader. And I saw a lot of guys, they did great in 99. Everybody and his brother was starting a hedge fund in 99, 2000. And all those guys went out of business. Some even got into serious financial trouble because they got over leveraged. But I think when you get hit, the ability to come back is a key thing. So even after leaving O'Neill, I experimented with running some funds, and that was a total failure. And I realized that I'm an independent trader. I can't run other people's money. I can teach other people about the market the way Bill O'Neill taught me, but I can't run other people's money. So that was a big lesson for me, and so I had to recover from a period of, I'm not going to say dejection, because basically I failed trying to run other people's money, to say from 2006 to 2011 or so, 2012. And then in 2012, 2013, I just completely chucked any money management aside and went back to running my own money. And since then, I've had 4 up years in a row, averaging about 56% per year. And I've never in my career had more than 2 up years in a row. So to be able to succeed, and I've even had a triple-digit year, I think, in 2014. So to me, doing 115%, which is what I did in 2014, was a much greater achievement than doing 1,001%, which I did in 1999. Because in 1999, that was pretty simple. You just jump on the train and catch the ride. And so to be able to achieve those kind of returns and that average return over the last 4 years, to me, tells me that I've been able to recover and figure out this market, because it is quite a bit different than what I'm going to call the old days, which was the 90s, where you could buy any old breakout and stocks would just keep trending higher. Here, it's much more rotational, so you need to find an edge by trying to buy stocks closer to the inflection points off of their lows, which that's where the pocket pivot, the bottom fishing and roundabout pocket pivots that I like to use come in very handy. Also, applying a lot of Wyckofffian techniques. You know Richard Wyckoff, right?
We don't know him. I mean, we obviously have heard of his analysis.
Don't know who Richard Wyckoff is?
I know who he is. I don't know him personally. I know Wyckoff analysis.
Well, he's dead, so you can't know him personally unless you hold a seance. But he was he was the guy who first he came out with the magazine of Wall Street. This is in the early 1900s, and he was the first one to chronicle and write about Jesse Livermore. And so you can read books by him: Stock Market Technique 1 and Stock Market Technique 2. I think How I Trade in Stocks by Richard Wyckoff. It's Wyckoff, and I would recommend everybody read this guy's stuff, because you'll see that O'Neill takes a lot of his stuff from Wyckoff, because he was describing what Livermore did. But you look at Wyckoff and Livermore had what he called a pivotal point, which was not a pivot point breakout from a base. A pivotal point was often a reversal point after a stock was in a downtrend. And then Wyckoff had the buy point off of lows that he called a springboard or a spring, where a stock would undercut a prior low and then turn around and rally, and it was that shakeout below that prior low that set up the rally. So I use that now as a setup. I call an undercut and rally. I know Neil took that same thing and turned it into what he called the shakeout plus 3, but to me the shakeout plus 3 is not really that precise. I have a much more precise way of dealing with what I call the undercut and rally, or the shakeout plus X, however many points you want to call it, or what Wyckoff called the spring, and what Livermore called the pivotal point, a reversal pivotal point. So, taking all that together, I've come up with my own philosophy, which I call the OWL, O'Neill, Wyckoff, and Livermore, OWL, and that's basically how I operate. You'll run into what I call a lot of CanSlim cult members, that are so narrow-minded that they're going to stick to this system because they've been brainwashed into thinking that it is the only thing that works. And I can tell you that when I was at O'Neill advising over 600 of the top institutions in the world, they would laugh at the whole concept of buying breakouts. So to me, if these big guys are telling you that this isn't really the way they operate, if I want to ride in their footsteps or follow in their footsteps, then I want to find out what they're doing a lot earlier, especially in a rotational market where you don't see any long-term trends developing, but you do see a lot of zigzagging up back and forth. Look at a stock, say, like Tesla. That thing hasn't really gone anywhere for the last 2-3 years, but it's had these huge price moves back and forth. And if you can play those both ways, long and short, and the last book I wrote was a short-selling book, you can make a fair amount of money and compound your returns that way. You have to be a little more active than you would, say, in a trending market like in the 90s, but it can be done. The market can be conquered, despite the fact that I hear a lot of people talking about how these are difficult times and it's not the right market, it's not the way it used to be. Well, in my view, the market's never been the way it used to be. And if you sit around waiting for things to come back to a so-called normal state, I think you could be waiting a long time. And in the meantime, there are enough what I'm going to call intermediate sort of rotational trends occurring in the market that are substantial enough that you can make decent money if you know what you're doing.
A few quick questions out of the chat. Is looking for a pullback pocket pivot on the financials worth considering at this point?
Well, I'll tell you where, if anybody follows me on Twitter, you can follow me at Gilmore Report if you want to. You could see that stocks like J.P. Morgan and Goldman Sachs, they had their initial moves. I think there's like a 5 or 6 day move straight up. I'm looking at the chart on J.P. Morgan now. But if you look at on 11/25, November 25th, the stock then went sideways from the 14th to the 25th. And at the 25th, it had a buy point that I refer to as a voodoo buy point. So in other words, the 10-day moving average had caught up to the stock. And at that point, the stock met up with the moving average, and the volume dried up to about 60% below average. So that's a volume dry up, a VDU, or to make it sound more mysterious, I like to call it a voodoo day. Throw in the rattlers and the whatever else, the chanting to go with that if you want. But from there, the stock actually took off, and now it's gone from about 80 up to about, what are we at now, 85 and change. So that was a buy point. At this point, I think you're looking for some sort of a base to form, something coherent. Those are pretty big moves. I mean, for J.P. Morgan to run from about 70 to 85, that's about a 20% move in about, 4 weeks? I think that's got to take some time in here to settle down. The other thing is, what if the Fed is just one and done? What do you guys think on that? You think the Fed's going to be on a trend of raising rates continuously throughout the next year?
I don't think they can.
I don't think they can.
I don't think they can either.
So what are they doing? One and done? Okay, if these financials are rallying on the basis of a higher interest rates to come and steepening of the yield curve, which of course makes their business more profitable, how long can they go on that basis if the Fed stops? Or let's say something happens and they're left with having to reverse, then what happens? So it's a little bit news-oriented. Now, the other dynamic that I may have completely overlooked is the fact that the Obama administration was, in fact, that bad for the banking industry. And with him out of the way now and Trump moving in, who's supposedly going to be more favorable and roll back Dodd-Frank, well, maybe that sets up a long-term move for the entire sector. But if that's the case, then the move that you saw in early November that began, that's just the beginning. And you'll see another setup, and I'll be looking for bases to form and maybe buying them off the lows of those bases rather than chasing them up here. But I certainly wouldn't chase them up here.
Gil, which one of your books is your favorite?
Well, I'm going to say I like the two end books, the first one and the latest one. I'm going to say because I worked on that one mostly myself, and it's pretty much all my own work in there. It would be the short selling book, which is Short Selling with the O'Neill Disciples. So it's very helpful to have my colleague Dr. Chris Katcher backing me up on that and checking my work. So that was very helpful, and he's very technically oriented that way, having a PhD in nuclear physics and also being the co-discoverer of, I think, element 109 on your periodic table of elements. So he's a good guy to have checking the details on your work. And I think that book was a seminal work in the sense that it took the initial short-selling strategies that were outlined in the book that I actually wrote for Bill O'Neill, How to Make Money Selling Stocks Short, that was published back in 2004. It took those to a new level, and we used daily charts rather than just weekly charts to show how short selling is done on a granular level, because it's a lot more difficult than going long by a long shot. You want to run out of breath and get tired fast, be a short seller.
All right.
It requires a lot of activity.
Real quickly before we let you go here, just tell us about the Gilmore Report and how people can find it.
Well, one of the things I like to do, I'm trying to help people achieve what I've achieved, and I'm trying to do it at a price point that I think is very reasonable. There's a lot of so-called gurus out there charging $500, $900, $1,000 for their so-called service. But all I'm going to do is do what Bill O'Neill did, which he served as an example to me. And he would talk to me about what he was doing and what he was seeing in the market. And so I try to emulate that in the Gilmore Report by just giving people an idea of what I'm looking at, but also to give them an idea how to set up their own strategies and how to look at the market themselves and the sorts of things to look at any given time. The other website, Selfish Investing, I do with Dr. Chris Katcher, has a timing model. We put out alerts on pocket pivots and whatnot. So, but, they're low-priced websites. We're not out to make a fortune pitching websites. We're out to help people and make most of our living as traders and try to be true to what we do. So, and in this business, that's always not a easy thing to do, right?
Gil Morales is a proprietary trader and CEO of Gil Morales and Company. You can find his Gilmore Report. Also follow him on Twitter. Gil, thanks for staying on so long. The chat really enjoyed it. Dennis and I learned some things too, and we hope to have you on again soon.
Yeah, definitely. We look forward to it. Thanks, Joel. Take care.
Thanks, Gil.
All right, Dennis. I like how he talked about Jesse Livermore, Wyckoff, and I had that earlier conversation. He just didn't just go with the O'Neill strategy, or he just didn't go with the Wyckoff. It was just kind of an accumulation, and then stuff that he learned on his own.
And it's something that, we stress on this show a lot of times. Over the course of the last 3.5 years that we've been doing the show here, it's strategy rotation as well. I mean, it's one method that works, at a period of time, but those methods don't always work. I've been trading prop for 17 years, and I can tell you about this thing, and I've talked about it before, strategy rotation. And what happens is in every single strategy, there's a natural rotation cycle. And at the top of the cycle, everybody is doing the strategy because everybody has heard of it. What happens is those strategies get crowded at that, and then they stop working. And once they stop working, I'm sorry, I'm still fighting this cold for 6 weeks. It's driving me nuts. But once they stop working, then, people stop doing them. So, and then what happens is it starts to rotate to the bottom of the cycle where nobody's doing that strategy anymore. And then what happens? It starts working again. And then, people start doing it. So it naturally rotates. So trades become crowded, strategies become crowded as well. When they stop becoming crowded, those strategies can start working again. So the one benefit, I have as of 17 years is I have a lot of strategies in my toolbox. But when you develop a strategy that works and it stops working, I never just throw it out. I never just get rid of it. I kind of put it in the bank and say, okay, it's not working right now, so I'm not going to do it right now. But when a different market environment comes in, those things can change. And when you have that different market environment, that old strategy that wasn't working maybe a year ago maybe starts working again. So, it's all about being able to adapt to what your current trading environment is and having the tools to adapt to it. So as you're a trader and as you're building, your strategy toolbox, you need to be able to cycle those strategies in and out and recognize when breakouts might work, or when, breakouts are not working, or when pullbacks, pocket pivots, lots of different strategies that, that Gil just talked about. But, we've talked about probably hundreds of different strategies on the show over the course of the last 3 years. Some of them are going to work at different periods of time. Being able to identify those periods of time is what is going to make you money in the long run.
All right, it is 9 a.m. here. We're going to wrap up the show, and we've had an hour here with the S&Ps have not even moved two handles here. Now trading the March contract, pre-market low 49.75. That'd be a big level to hold. Not much in the 22.40 handle. On the upside here, your close 22.54.75. That was your old-time closing high. Pre-market high, 10 handles up there, up at 64.75, so that could be a target on the upside. On tomorrow's show, we're going to have a couple good guests. We're going to have the final appearance of the year for Scott Red Dog Redler. Also, Nick Shaheen is going to be joining us to talk about what's going on in the option markets. Just a quick reminder to check out Benzinga Pro, Benzinga's real-time news platform, perfect for anybody looking to stay on top of what's going on in the markets. With Benzinga Pro, you get access to our daily market-moving exclusive feed, audio squawk, and real-time SEC filings, as well as the biggest headlines from across Wall Street. It's priced with retail investors in mind. To get your free trial, email Spencer at spencerisrael@benzinga.com. All right, we're going to wrap things up. Spencer will be back in the driver's seat tomorrow. Have a great trading day. We'll come back with you tomorrow.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.